people. Tim. Good afternoon, everybody. Yeah, I'm the deputy. Did you not know that, Tim? Councillor. I got the mini one. Welcome, everybody. So we are here to talk about the Wellington City Disaster Resilience Fund, which we have all, which we've all received the PowerPoint presentation from slightly earlier and have read it in depth, which is good. There are some hard copies here, and we do have a number of councillors and the Mayor online as well, so I'm hoping they can hear and see everything that we need, so we will need to use our mics when we have questions at the end, which I'm sure we will. So I'll hand over to Raina to start with, and she can kick off. Thanks.
Kia ora koutou, good afternoon. Thank you for being here today. So we're talking about the Disaster Resilience Fund, and this is as a result of decisions around the LTP amendment, proceeding with our preferred option, and working off workshops back in December as well. So today's session we're focusing on really those key decisions that we need to make next in order to help set up this fund. So we consulted as part of the long-term plan amendment on selling the 9 ground leases and using those funds to set up this disaster resilience fund as part of our financial strategy. On the 22nd of May, you will recall that the preferred option was approved to proceed, hence we're here today. We'll summarise the fund design options today for you, noting that some of these decisions won't be able to be made until the new council is elected and the committees are set up then. So previously this paper was coming for you for decision making at the end of June. We've moved that to August, considering the significant decisions that you need to make around the long-term plan amendment. So it's to make sure that you have enough time to absorb all of this information as well before you have to make a decision on it. So we're really here to kind of get your feedback, get your ideas, see if we're kind of heading in the right direction in terms of our thinking. Just pushing out to the longer kind of timeline, we're planning to get the fund up and running in February, March of next year. Hence, it's really important for us to get some of these decisions made now so that we can help inform all of the relevant documents that we need to create and bring back for you for approval. So just a reminder here of how we've got to this point. So back in October, it was agreed that we would continue the work on the Disaster Resilience Fund to provide a form of self-insurance. On the 17th of December, the committee agreed on the 3 options that we consulted on through the long-term plan amendment. And then on the 13th of Feb, we agreed their preferred option, which was to sell the ground leases and set up a small fund. On the 28th of April, the council agreed to the sale of the 9 ground leases in order to capitalise the fund from the proceeds, and in May it was approved or agreed to proceed with a preferred option. And then moving ahead into the 20th of August, which is the date that the report will come to you for decision making, this is where we'll be asking you to agree some of those key decisions as part of the Disaster Resilience Fund design. So we've got a few sections in here, and I think given the content that'll be in there, we'll kind of finish each section and then we can come to questions at that point. That works. So a reminder about our financial strategy. So our financial strategy looks to help mitigate 2 financial issues that have been identified. Firstly, around the lack of diversification of our investment portfolio, in the sense that all of our assets all of our investments are in Wellington and are exposed to the same risks in case of a natural disaster. The second is our underinsurance issue, and that's the $1.8 to $2.6 billion underinsurance gap that we have. So the objectives of setting up the Disaster Resilience Fund is to help mitigate partly mitigate these issues, in that we will be selling some of the ground leases that we currently hold that are situated in Wellington and therefore exposed to those same risks, and using those funds to invest generally outside of Wellington where we're not exposed to those same risks. So in doing so, the objectives of the Disaster Resilience Fund is to embed a governance structure so that the fund can be accessed for specific purposes, and that is that natural disaster. So making sure that's really, really clear in what we're doing in terms of the purpose of those funds and how those funds can be accessed is going to be really, really important. And at the same time, it's looking at how we grow that fund over time. And these decisions around the investment returns and how they're used, whether or not they're reinvested, offsetting our rates to match the same level of revenue that we were getting from our ground leases. So that short-term impact on ratepayers is what we consulted on the community with, that there would be no short-term impact of ratepayers. Therefore, in the short term, it is likely that we will be recommending that those returns are used to offset that lost revenue from the ground leases. In order to have some independent expertise as part of the decision making, where our initial thinking is around a separate committee that has independent members with investment expertise to help ensure that those decisions are supported. Right, I'm going to pass over to Jesse now.
Kia ora, and thank you for having me. My name's Jesse Phillips. I'm a partner at KPMG and been involved in this work. I talked to you back in December. Look, I won't spend too much time on the slide. It sort of repeats, I think, the ground that Raynell's covered, but it is worth thinking, you know, if we were to set up the perfect tool to help with your underinsurance problem to accommodate a disaster, what would it look like? That tool essentially would grow. That would provide some capital growth. It would provide income in good times. But then when there's a disaster, it would either have continuity of that income or it'd be available to pay out capital to help support the recovery. And if we think through the three types of tools you have here to support that underinsurance problem, you have a bunch of current assets, including the leasehold land. Obviously meets the former, produces an income, but should there be a disaster, it's not necessarily there and available. You've got debt headroom that you can maintain through time, but it doesn't grow, and if you draw down on it, it necessarily needs to be repaid. Or you've got the Disaster Resilience Fund, which effectively ticks both boxes, and structured in the right way. Should there be a significant natural disaster, you've either got continuity of income to support rates, or you can make a special distribution, a call on that capital to help support the recovery, and that's what we're aiming to do. We've designed the discussion today around 5 key questions, some of which we're going to go into in a bit more detail, some of which we won't touch on. The first one is the structure and governance of the fund. We're going to present some options around at a high level what the structure of this fund could look like, looking at what other funds have done previously, and that's what we touched on in the previous session. We're not going to go into the details of the makeup of independents versus council members in this session. That's for a future conversation. We're going to look a little bit about the rules, the circumstances by which the fund could be accessed should there be a material disaster in which you'd pay what we call a special distribution of capital. What are the circumstances that would have to be met? We're going to talk very briefly about what the fund would invest in. There's further information on that to come because it'll be documented in what we call a SIPO, and you'll have an opportunity to input into that document. So we'll talk about it at a high level but not drill down in too much detail. And then there's a really difficult discussion or series of trade-offs here around what happens to investment returns in this fund. And we'll present the bounds of that, either retain all of the investment return in the fund, pay all of the investment return out to support and ameliorate rates, or somewhere in between, and present what those trade-offs look like. The fifth question, how the fund will be capitalised, as Raynell said, decisions have already been made on that. We're not going to relitigate that in this for, and we'll make the assumption that it is the ground leases that we've been talking about, which have an approximate value of, I think, between 68 to 100 million, depending on how many are sold. There's initial 968 million, and that's been the working assumption. So I'm going to ask Scott to step through some of those design choices, and as I say, we can take questions now or as we step through section 3, whatever works.
Yeah, we just have a couple of questions to start with. So, Councillor Wanera.
Just a question on procedure, I guess. So is this going to be kind of workshop styles? Are we invited to give reckons, or are we just receiving?
The purpose is to get some conversation going as part of this as well.
Okay. Could you just explain why we're now calling it a DERF instead of a PIF?
It's probably our fault. We thought that better reflected the nature of what it is we're trying to establish as a fund there for the purpose of disaster resilience.
Okay.
If councillors felt strongly, we could call it a PIF.
Yeah.
Fair enough. But same kind of strategic purpose.
yeah.
Cool, great. And this is probably going to be asked and answered in section 2, but I'm keen to hear when we get up to it whether and how we can bind future councils from drawing down on the fund. But we can get there when we get there.
Yeah, we will get to that. Councillor Young. Oh, yeah, okay.
There's just one further thing I'd say. We've provided in this deck an indication of travel based on our advice, but there are some difficult decisions. The intention here is to get your feedback, generally buy into this process so that we can make and come back with a recommendation in line with what you'd like to see.
Councillor Pennant, do you want to go now?
Yeah, maybe you'll come to it later, but just having councillors on a committee, not keen. I think once we set the direction, I think then it could get very political. Should be held, that's right, it needs to be held at arm's length. Anyway, just some feedback.
We'll take that on board. Thank you, Councillor.
Councillor O'Neill.
My part is just kind of around what kind of models the committee would be using in terms of their investment. Is it going to be like more complex one, more conservative, or what direction are we setting around that?
Yeah, in terms of models, you mean the investment thesis, how they're going to be investing, what sort of things they're going to be investing in?
Yeah, I guess the dynamic part of it, like how safe are we going to be playing, or are we looking for more ambition, more risk, higher return?
That's a really good question, and we will come to it. Scott, do you want to jump in?
Yeah, we'll jump into the SIPO component, which basically is the rules that sit around how the investment is managed, and we'll add to that discussion at that point.
Okay, continue.
Seems like I've got the microphone now, so I'll do my piece. Look, I'm Scott Hamilton, so I'm here to support, obviously, Council and KPMG in terms of the process. My background is in the funds management industry, but more recently I was the head or chief executive of Quayside Holdings, which is the investment arm of the Bay of Plenty Regional Council, and I now consult to a number of local government entities in similar spaces to this. So in terms of going to the next slide, I think you've already raised between some of the questions that you've identified here is some of the key challenges that we actually have. There are a number of options that you could end up with in terms of a structure, and I realise that we're not looking to set the structure in August, but maybe a little bit later, but this will just highlight to you some of the challenges that we're working through. At a governance level, you can have it as just a committee of council, or you can have it fully outside as a CCO or a CCTO. With a fully independent board, and you either have, in terms of reference, if it's a committee of council, or you have a constitution and maybe a statement of expectations if it's a CCTO. Do you have councillors only on the governance? Do you have full independence on the governance? Do you have a blend? How is that blend executed? Protections, which is the next one, how do we make sure that we have protections both of the capital, but also of, I guess, the income and the decisions and the rules that go around that. The more protections you wrap around, the harder it is to get in, whether well-intended or unintended as the case may be. And then each of those also has costs as well. The more belts you put on, the more expensive it is to buy all the belts effectively. And so you've just got to think about each of those things. Where we are today, $68 million or $70 million or in that vicinity is not a large fund. And so, you've got to think about a lot of the costs that you set are quite fixed. If you've got a bigger fund, it's cheaper. If you've got a smaller fund, it's not. So that led us to basically looking at 4 options that sit along the bottom. An internal fund, which is effectively then a fund which is owned by council but operated through the council committee process. The same again, but with independence in that committee process. Thirdly, effectively a council-owned fund but with an external governance through a CCO. Or fourthly, an externally owned, externally governed fund. So you've got each of those different options. If we go to the next slide, thanks, Raina. So, and as you can see, basically, you know, there are trade-offs effectively for council in terms of each of those options. And so if you look at option 1, you know, you don't have independent members, which potentially may mean you don't have the level of expertise that you would otherwise have. You don't have the necessary intergenerational protections because you haven't structured things around it to try and protect it. It is a low-cost option, and there are examples of councils that have done that in the past. Environment Southland is one that's named there. They've recently moved towards an investment committee structure with independence. Again, what I will say about the examples, though, is take each of them with a pinch of salt, because every council is different. And every council's reason for having an investment fund and how they structure it and how they need to protect it is different as well. And so, you know, in the case that we're looking at here, you're thinking about disaster resilience and how do you then unlock it at the point of disaster resilience, but maybe not at other times before that. And so those are the parts of the challenge that we're looking at. So again, just working through each of those options, intergenerational protections for option 2 is greater because you've got some independence there and it's still relatively low cost. And then you step outside that council scenario where you're creating CCOs or CCTOs, which is a consultation piece in its own right to go and create those, but that opportunity sits there as a further step for options 3 and 4.
As Scott mentioned, you know, one of the key drivers or one of the key trade-offs you have is the cost of these relative options versus the intergenerational protections you have under each of those options. The slide tries to set out, with some benchmarking on examples that we've looked at, the relative cost of those governance layers associated with each of the options. It does not include the management of the funds, the fund management fees that would be paid, based on some assumptions around the relative number of independents sitting at that governance layer. So we've necessarily had to make some assumptions. And what I would say for a fund of the scale, the cost of governance and the cost of the structure you put in place is material, given it's largely fixed. The larger the fund gets, the more ability you have to spread that cost over a wider pool of assets. And so it is a pertinent consideration. And one of the key reasons our initial direction of travel is moving towards a lower cost option, which is option 2. So these options range from about 80,000 on an internal fund, made up of both people and other costs such as reporting, 140,000 benchmark for option 2, which is our initial thinking. Option 3 slightly more expensive because you're going through the process and having a CCO established for the purposes of governance, all the way to option 4, which is a fund owning CCO, which is where Auckland have landed in the Auckland Future Fund, and that 400,000 is their forecast budget that was prepared or provided in their public-facing documents around the cost of administering their funds. So the intention around this was to give you a guide of the cost trade-off that you're going to make in evaluating these options. I guess the other point I'd make here are there are some tax implications. By definition, a CCO that owns assets or a fund like this is highly likely to be a taxable entity and therefore pay tax. My understanding, Auckland have faced that circumstance, and actually to avoid that, they've had a passage of legislation, a bill passed that deems the Auckland Future Fund tax exempt. They could not structure their way around that. That was the outcome there. All of the others will benefit from the council's tax exemption, and therefore there are minimal tax implications along those structures.
If I can just add one more thing there. So those estimates in terms of costs, while they're relatively fixed at 40 basis points or 0.4% on a $100 million fund, that is on a $100 million fund. You're not quite at target 100 million on day one. So you've got to appreciate that those things are actually higher as a percentage when you have a smaller fund.
Thanks, Scott. We've got a couple of questions that will go to Councillor Young.
So first of all, just want to check this one. People cost estimate. So that's $20,000 a year
Yes.
for all the people, or per person,
No.
as well as per year.
So on that first example, it's an internal committee of council, so there is an assumption that basically councillors are already councillors. You do have some POIWI costs, that may be associated with that.
Councillor, it would exclude staffing costs, so we would need to look at the capacity that we've got internally, which...
But I'm also concerned about the legal liability of someone on a committee like this. I mean, if I was a councillor and I was asked to go on this, I think I would say, no thanks very much, because of the liability. So that's my first question. But the second question is, so I gather in similar situations in Australia, what some councils have done is they've kind of buttoned on to some big Australian government investment fund, the superannuation fund or something like that, which means they have very few costs and they're part of a much bigger organisation. Was that considered for this? And would it be possible?
Look, that part of it is effectively, there's two components. One, this piece here is looking at your internal governance and how do you put the rules and the regulations that you want in terms of how the fund is managed. The second part of it is who manages the fund, and in some cases in Australia, you're right, they have looked at other larger entities like a QIC or someone like that and said, well, you can go and manage our assets for us. That's the management of the fund itself. So you've got the council component, which is what this is trying to assess.
Sorry, what would the council component be if they're not managing it?
That you would still need these costs, because ultimately, even if we were to outsource the management of it, we would still need governance over the decisions that are being made. And so these are the minimum costs that you would have under that scenario. So in effect, that's option one. But it excludes all the operational costs of managing the fund. This is just talking about the governance setup in terms of...
Just thinking of councillors generally are not experts in investment, so what oversight could we possibly give when would be like asking me how to run a cattle farm?
So you as councillors or the future council will have a view on where you want investment in the monies to be invested in or not invested in. So that would be set out. You would have those kind of things that you would need to determine. You would also, as with any other investment that we've got, have a level of expectations around how things are operated, and you would need to set those.
Okay, thank you.
If I can just add a fraction to that as well. If you think of it this way, even if you outsourced it to an investment manager, whether it is a government-related agency or not, you still need a board or something or a governance committee internally that can then assess whether that entity is doing well, because you need to be able to monitor that performance and monitor all of those other things, and so that really is where that entity sits. And as we'll discuss soon, there are some other considerations for that entity as well around the access to the distributions, etc. as well, which come from the portfolio. Yep.
Councillor McNulty.
Yeah, you've answered some of it in the previous one. I was going to ask around what governance decisions do you envision a committee making? In terms of the reporting costs and audit and the like, that can be covered by the fund manager though, can't it? Like I'm just thinking of, yes, albeit much smaller, but the managed funds that I have, they do tax and audit requirements and come back through me. What additional reporting and audit requirements would the council need to do on top that a Simplicity or a Fisher Funds could not already do for us?
So I'll pick up on some of that. So some of those other costs are costs associated with the board. Others are things like you don't have a fund at the moment. So there is IFRS accounting that you will have to put through your annual accounts. You'll have a more complex audit. If you have a CCO as well, you've got to audit that. If the CCO owns the assets, then effectively you've got two complex audits that go through at a group level. So it's all of those other costs that sit in behind, which are just a byproduct of owning the asset. I agree with you that a Simplicity or anybody else will do management reporting, and you would expect management reporting to come back. So they will do all of those things. You still have to do the accounting operations. You still have to do the management and other things that sit inside this entity.
2 years and I'm still blown away by how much things cost council when we need to do anything. Thank you.
Councillor Randall.
So should we choose a particular option and the fund grows, is it possible to change options essentially and, to an appropriate scale?
That's a really good question. Should this get to a certain scale, is a different structure more appropriate? And I think the answer probably is yes. You might choose a low-cost option with a lower level of intergenerational protection. But this is wildly successful and grows, or for another reason, there's more capital in here and ability to ameliorate, offset that cost base. Yes, it might be very appropriate to move, say, up the scale to options 3 or option 4 for exactly that reason. Where that boundary is hard to know. We were having this internal debate. If I had to put a finger in the air, 250 million, you start bringing the cost of this down, but at 68 million, that's not our judgment.
And I think if you can just add to that, if you take the Environment Southland example, they have moved from an option 1 to an option 2. And that's basically as the size of the asset is growing and as they're starting to do more independent things, they need to get greater expertise through their organisation.
Councillor McNulty.
So I do actually have a bit of sympathy for what Iona said about wanting councillors as far away from this thing as possible. So are there any other options that aren't on there around governance, like really just like internal stuff, delegation, and it feeds back as reporting to LTPFP or things along those lines initially? I'm actually keen to have councillors quite far away from this thing once it's going.
I think that's definitely something we can look into a bit more, into how we can structure that and kind of bring back those options for you in August.
Correct me if I'm wrong, but that's more like option 3, isn't it?
It is probably more like option 3. I don't know. Like Councillor Panovich pulled out his calculator halfway through there. I was quite impressed. So, but yeah, it is. I don't know. He pushed a few buttons and then he looked at it and shrugged. So,
7% return.
That, your option 3 is probably more akin to that kind of model.
Okay, cool. Let's continue on.
Okay, so we're into design choices. If we can go up to the first one. So look, this one here is probably an expansion of option 2, but you'll excuse us just for diving into one of them. But this is just to give you an indicator of where this could be. So, and just so you can understand the structure. So you have council as the governing body with a committee. Council is the owner of the asset, and the committee appoints an external manager, a fund manager, to effectively manage the money, or to do all the transactions in relation to the money. The rules that are sitting there in terms of council are as council's rules, but they are executed basically by that external fund manager. So the example that we've got, and this is just an example, so it could compromise membership such as 3 independents, including a chair and a deputy, a couple of elected members, and an iwi representation. And the quantity of iwi representation, I don't think we've actually worked through yet. The role of the committee is actually the important thing. So why do you need to have a committee there? And the first thing is, and we'll talk about each of these individual points, working out when there is a special distribution from the fund. So when we're talking about a special distribution here, this is a distribution of the capital of the fund. So this is your disaster event, effectively. So when can you take the capital out? The involvement and selection and appointment of the investment manager. So you're basically looking at this committee to be the ones that choose who the manager is that you will use. Looking at reviews and recommending changes to the SIPO. Now the SIPO is a controlling document of councils, but you'd expect to use your experts to help you in terms of any changes and recommendation to the SIPO that you may want to see. And the fourth point, and we'll come to this one as well, is working out what is the annual payment out of the fund, if any, and I guess that's a discussion to have, from the ordinary distributions itself as well. So there's that portion of what is the annual piece that it feeds to you every year, and then under what circumstance can it pay out. Each of the other options obviously is slightly different to that, whether it's creation of a CCTR or otherwise, but that's just an example of one of them. we go to the next slide. In essence, there are 3 key documents that we really need to think about. And the first one is a policy document around what I've called the DRF at the moment. We can change names later. But this basically is the rules. So this is the council's rules for how the fund is to be used. And so this includes how it's going to be governed, how it's going to make distributions at a disaster event and what are the triggers for that disaster event, and how it's going to make distributions on an annual basis as well. The second one is we'll call it a terms of reference. Now it's a terms of reference if it's a committee. It's a constitution if it's a CCTO or a CCO, and it's probably a statement of expectations as well as part of that. But that is a document there which again sets down how it is going to be governed. And the third document is the SIPO. The SIPO, again, is a policy of council, statement of investment policy and outcomes. It's effectively the rules around how the fund is managed. So I think the question earlier came, how risky are we? What do we invest into? What are we trying to get as a return? What is our ESG standards? All of those other types of things. All of those things are documented within your SIPO. Your committee or your CCO then has to execute that SIPO and make sure that is actually executed. So you've got those 2 governing documents, those 3 governing documents, which is really what this is all about, and it's all wrapped up inside that.
One of the key questions that we've been asked to look at is when and how the fund could be accessed, and the slide here has our initial thinking on that. It's really important we're very clear on the circumstances you can make a special distribution from this fund, and so what we've set out here is essentially 2 steps. The first step is following a potential trigger event. The council can request a special distribution from the fund, and then it's up to the investment committee to go through what we say is a 4-pronged rule to determine whether they recommend that a distribution is made because it's consistent with the policies and objectives of the fund. And we've set those out as an example on this slide, what those 4 limbs would need to be. You'd have to meet all of them for a recommendation to be made to council that yes, it is appropriate to make a special distribution. The first one, there obviously has to have been an external event that affects the infrastructure or the built and physical assets of the city. The second, that event has to have or is expected to have a material financial impact on the council. The third is that you've exhausted or looked through all other reasonably viable sources of funding. There may be other opportunities to help fund the recovery that don't involve liquidating this fund. And then lastly, making a special distribution is in the benefit of both future and current ratepayers of Wellington than keeping the money in the fund. And that last one is consistent with what we've seen in other governing documents for these types of funds with other councils. And that presents a relatively high bar for access, and that's appropriate because that's the purpose of this fund. But the other benefit of it is that it allows the fund manager and the investment committee to invest these funds on the expectation there's a very low probability that they're going to be accessed in the short term, and therefore can invest in high growth assets and chase some capital return, accept a level of volatility so it gets a good return and grows through time. So that's how we've been thinking about the sort of distribution or special distribution rules and what they might look like in the governing documents. Obviously happy to take any questions or feedback on those as we go through
We've
this.
got 3 on the list at the moment. Councillor, no, 4. Councillor Pennant.
Sorry, are we up to the part where we'll say what's in the SIPO?
It's a couple away yet.
Oh,
The SIPO's coming about how the fund is going to invest. This is about taking money out.
okay, it's fine. Can I go back on the list then? Thank you.
Yep. Councillor Winiara.
So council has the ability to make a decision which is inconsistent with its financial policy. What mechanism is in place for such a committee under this model to make a decision inconsistent with a DRF policy? What I'm asking is, could and how could a committee sidestep these rules?
Beth is going to come up and help.
Kia ora koutou. So that's what we call a Section 80, which is when there is an inconsistency with a council policy. It is permitted. Really, the procedure that the council will need to go through depends entirely on the circumstances and really the nature of the departure from the policy and how significant it is. So it might very well be that for council to determine that it wanted to make payments out of the fund that were inconsistent with the policy, it would have to turn its mind and go through a significant decision-making process. But it might very well be that it is not. And it really just depends on what the circumstances are. So I guess I'd just say the risk that the council makes a decision that is inconsistent, it is a judicial review risk, so that someone can seek to take a judicial review. There isn't really any other real risk associated with it.
Is there, I'm just speculating wildly now, but is there anything in the LGA which might mandate consultation to occur in such a circumstance?
No, it really comes down to significance. And what we've looked at, well, I've been supporting Joe, who's principal counsel on the team, who's supporting the team, around how we can set up the policy to say we would expect this to be a significant decision and a consultation would be required. The reality is it's going to come down to the decision-making of the people around this table about what you want to do. And I think that's the real limitation here. And if I can just say, as we know, council can undo the decisions of its committees, and I think that's the real issue with this structure.
And sorry, last question. Could we designate the fund as a strategic asset?
Yes, and that's the intention.
Okay.
But remember, that means that it talks about control of that asset, right? It's not talking about the decision to pay out from that asset. Yeah.
Councillor Rogers.
My question was around whether all other funding sources had been utilised, and I guess I was just trying to think through the scenario where in our policy at the moment we maintain both debt headroom for the purposes of responding to natural disasters as well as this fund, and I was wondering if you might be able to briefly talk through how the tension between wanting to retain some debt headroom and also being able to utilise this fund would perhaps play out in a disaster scenario in terms of that full utilisation of all other funds.
So it's anticipated that this would operate in a disaster scenario as part of the hierarchy of the insurance monies that we could expect to receive, along with the any other assets that we may be able to recycle / fire sale or whatever that sort of looks like. So it would be, if you think of our insurance stack, colloquially, we would obviously work through, damages significant enough to have used all of our insurance capacity payout, or it's likely to do so, noting that insurance can take many years to pay out. Looking at the alternative mechanisms that we have, say, the headroom that you point to and other options there. And then this would kick in once we determined that we're likely to burn through all of those, structuring it up. Sorry, these are the conversations we've had in the background, but my advice would be to structure it up as a parametric type solution whereby we could get access to the funds once we've proven that we're likely to burn through all of that. So say it's a small event and insurance will cover it, we wouldn't necessarily go near this, but if we sort of were looking like we would burn through all of those other alternatives. And that's going to move through time as well, right? So as we buy more insurance, that's going to push this further up the stack. We don't want it to, from a perception point or from an optics point of view, we don't want this to be the asset of first resort or the first liquidated, first line of defence, if that makes sense. So we need to send that signal clearly to our insurers so that we can buy, so it doesn't work as a deductible, say, and then also to other people who may pitch in, central government, etc., that we're not self-insuring in this way. We've burnt through all of those other options first. Does that help answer your question?
Yeah, I guess it was more just around, like, we have borrowing limits imposed by the LGFA. Yep. Is the expectation of the policy that we're setting for this asset that we would expend our entire debt headroom before we're able to access the fund?
It would talk to our financial strategy of the day. So if we were doing this and a disaster happened tomorrow, our first line of defence would be to use that, and then this would kick in, assuming that we would consume all of that. It's going to travel through time, grow and evolve, I think would be the answer to that. And I do think we have mechanisms in there where that assessment needs to be made by the governance. Well, that's what we're recommending.
Cool. Thank you.
Deputy Mayor Foon.
Just a couple of questions. Are there any examples of when other councils have had to draw down on funds recently?
Well, there's examples of EQC, for example, that did draw down on funds when they had the Christchurch earthquake. So that's an example of one where there was a significant event and they then drew down in terms of those proceeds. Most other councils, as I said right at the start, every other council is different as to why they hold investment assets.
Yeah.
Some of them are matched to reserves, and so when the reserves are spent, operating reserves are spent, then they draw down for those purposes. Very, very different in this scenario here because you've got a specific thing you're trying to address.
Yeah.
And it's really making sure that the policies address the scenario that you're trying to hit.
Yeah, okay. And next question, just over what period of time did Southland review the governance structure? Like how long did that take, roughly?
Look, they had effectively finance committees of council operating this for a long period of time. They've only just recently gone in and done that change. So they had they possibly should have done it sooner, but they've done it now, and they'll get that benefit going forward. So I think sometimes you need a trigger event, or you need someone coming in to sit there and say, hey, it's actually time. And in a lot of cases for investments, and I know this even from running in the investment entity that I ran, as you grew, your scope to do different things and your scope to have different forms of governance or different forms of management in-house, all of those things change. You need to be quite active in the way that you actually look at this in order to try and work out when is that next trigger point to go.
Yeah, thank you.
I've still got 5 on the list, so I'll draw a line after these 5. So Councillor O'Neill.
Yeah, I was just understanding the access conditions, and if we are setting this up to be around known emergencies, or if there's enough robustness to pivot if an unlikely emergency happened. Like, is there enough of a strong understanding of different probabilities?
It all really comes down to the purpose of the fund and the SIPO and all of the governing documents in terms of what triggers a special distribution. So I've got a slide up here which talks around some of those protections, and whilst we haven't gone through it, it's probably quite relevant to some of the questions coming up now. But it's really those documents and what is agreed at this council that will set the scene going forward. Noting, however, that these protections aren't as strong as they could be based on option 2 as they would be, say, option 3 or option 4.
Also, just adding to the points that Sarah made, that this wouldn't be the option of first resort. We would look in other circumstances as to the other options that we've got. So our own insurance, our debt headroom, those other kind of mechanisms as well.
Yeah, just quick supplementary. Keen to understand if there's a distinction being made between typical emergencies or unpredictable events, and I wondered what our definition was, or if that's...
That LIM 1 was a really difficult thing to draft because you're trying to accommodate what you think is the most likely event, which is an earthquake, as well as a raft of other options, and it's necessarily subjective. I think what we've tried to do is define it with regards to the outcome of the event rather than what the event was on the way in, and that felt like the best way to do it from our perspective.
Councillor McNulty.
Yeah, like Nico, I'm just trying to think of ways to break this in a sense so we can work around it. Ultimately, council's going to be able to make the decisions to get the money if it really wants to. But if we have an external CCO that has got a constitutional duty to look after these funds and release it only in extraordinary circumstances, and that CCO is delegated to basically say no to a request, is that one way of doing it? I'm just, so that, if the council's really adamant, well, they can change the constitution, disestablish the CCO and get the money, but we make it such a shit fight, technical term there, to do it, but that dissuades, let's call it improper withdrawals. Is that a potential strategy?
Look, I think your technical term that you use is exactly where we're trying to get to, which is that we are making it such that, councils can always undo things. At the end of the day, there's always a mechanism, but the more public you make it that you're actually going completely against the intent of what you were trying to do is really the process. So, yes, we talk, I probably talked to this group earlier about putting on 4 or 5 different belts. And each of those belts is another layer of protection. The question is, how many belts can you afford to wear right at the start? And so that's really the piece that we're grappling with here, is just trying to make sure that we put enough protections on there, and whether it's an investment committee that needs a majority of its independents to sit there and say yes, is one way, or is it the CCTO where it's fully outside and there is no councillor influence? Those are the different pieces that we're trying to juggle against the cost effectiveness of that solution.
Councillor Chung.
Just a quick question, and apologies for being late. What does ECG stand for?
I presume you're referencing ESG. And it's a typo.
ESG is environmental, social and governance considerations that normally take place with regards. So a lot of funds, when they invest, there are social responsibility standards that effectively that they try and employ to make sure that they are delivering the right outcomes.
Okay, so on with that, is there any obligation for us to be looking, or any responsibility for us to be looking at the best investments for return to increase the size of this fund, or is that not a consideration?
So look, again, and we'll come to the SIPO in a couple of slides, but the SIPO is all about the rules that council sets, and the more restrictions you have in terms of rules, the harder it is to get the level of returns that you want. And so therefore that's why that SIPO is effectively is a governance document of council. You've then got whether it's your CCTO or your investment committee or whichever structure we have, going out there and executing that with an investment manager. They have to apply those rules. So it's council's rules, but if you make it too tight, then your universe shrinks up and your opportunity shrinks up as well.
Councillor Brown.
This is more a question for Sarah. Sarah, I would like the fund to actually charge for the insurance. From my experience of self-insurance vehicles, often the insurance cover is provided in tranches, and it's not necessarily a sort of a single point, but it can be sort of slotted in depending on where in the stack. And I think that sort of thing would actually, provide income for the fund, but it would also provide transparency for councillors as to exactly what risk the fund was taking with regards to insurance. And if the fund was explicitly providing insurance cover, then obviously it would address a lot of the concerns other people in the room have got around people, sticking their fingers into it and pulling money out.
So we can look into that, but I'm not sure, correct me if I'm wrong, the intention under this particular fund was anticipated to be the insurance product. So you might recall that we're also looking, so let me finish my thought, we're also looking at a captive insurance feasibility at the moment that is more akin to something that would provide an insurance product to the council, but we're not as evolved in our thinking in that. This is obviously something that's tied to the long-term plan amendment that we've so hence why we're pursuing this and bringing this information to you first. Original thought was that those two things could be one and the same, or they would interact somehow, whereby this would be the capital fund that sits behind the captive insurance company. So therefore, you protect it with that extra layer of a fronting company that is very much at arm's length. In fact, here to Bermuda or wherever it is away. So. You don't want that job. I'm not volunteering for it. Anyway, sorry, I digress. But that would be where we could, I think, play that role. It would be more difficult to structure this as an insurance product if the intention is to use it and grow it as a fund, unless you anticipated we were sort of paying insurance premiums into it. That's a different conversation if we're looking at a captive insurance company. So it's, yes.
If I'm wrong though, isn't that the actual point? It's called a disaster fund. I mean, isn't it intended to be for disasters? And therefore, if you're going to build it into your insurance stack, in a conceptual sense, why not build it in a formal sense?
I think we'll look at that and come back to you, but I think the key thing here is we're taking one step at a time, and this is the establishment of a fund. At this point, obviously, we've got other actions on the go at the moment, looking at captives and how that gets structured, and we'll certainly look at that. That's absolutely no problem.
And other insurance products as well.
Correct. Yeah. And other insurance products as well.
Last round, Councillor Rogers.
You might not want another hypothetical, but my other one was around looking at number 3 again, in a scenario where I guess I would perceive the government to be less willing over time to be paying out for disaster recovery. And so you're in a situation where the council may expect liquidity or finances from the government, and the government might be expecting that the council would use all of its resourcing available before paying out. And so there's kind of this chicken and egg scenario in number 3 where the government is saying you can have funds if you use your funds first, and we're saying we can only access our funds if you don't give us funds and we've exhausted your funds first.
Yeah, and hard to avoid that dynamic. You make this too accessible and you absolutely undermine that discussion, don't you, immediately? I think inevitably you end up in that sort of conversation if the event's bad enough.
Okay, and cool. just to add to that hypothetical, if you take the Cyclone Gabriel as an event, Hawke's Bay Regional Council had sold a large share of its port. That was sitting on its books as a strategic asset, as a fund, and that was not rated as part of that process. Now, that doesn't mean it won't be in the future, but, you know, there are examples.
Okay, let's move on. Oh, no.
No, that's all right.
Okay.
I think it just one of the challenges is how that would interact with your insurance that you purchase and how that moral hazard would play out. I'll leave it with you.
Right, now we're kind of touching on those protections and some of the scenarios that you've kind of been talking about, right? So the purpose of this fund is in the case of a natural disaster. And in setting up this fund, we're looking at what protections it would have based on different governance structures. So our initial thinking, like I said, around option 2 is all the money would be in a fund that would be ring-fenced on the council's balance sheet, and the funds could only be withdrawn for the purpose of what the fund was established for, and that was in the case of a natural disaster. The fund would be governed by a separate committee in accordance with the policy documents that we'll be drawing up as a result of the decisions in August. And then the fund itself will be a strategic asset that's listed in our significance and engagement policy. So just looking at those and what the protections would be, if there was any decision to transfer the ownership or control of the fund, this would be likely subject to consultation via the LTP. Any decision to change the purpose of the fund or the distribution rules that will be set up in these documents would also likely require consultation based on the Council's significance and engagement policy. Where we're looking to set up a separate disaster resilience fund committee, it's recommended that we have those external independent members to help provide a layer of independence and expertise as well. There are limitations on the protections available through option 2. Obviously, options 3 and 4 provide greater protection, and as Scott was talking to, more belts around. So, yeah, they are limited in terms of option 2, and Council does have, I guess, the option to make changes to the purpose and to those documents governing the fund and the committee, for example.
So how will the fund invest? So this is your SIPO document that we've referred to all the way through. So again, this is a policy of council that sits on your website for people to see. It is a live document, so it is something that you change, periodically. But in that document, you look at things like what is your risk appetite. And so our assumption at the moment is if you have good protections around the use of the capital of that fund, then effectively you are an intergenerational long-term investor. You can invest into higher growth, higher risk assets. That will generally get you a return at 7% or greater after management fees. Things that we will need to work through with you as a council is, what are your guiding principles and specific exclusions around ESG? There's a lot of movement in this space at the moment. So organisations like the UNPRI, the United Nations Principles for Responsible Investments, are sitting in there as effectively guidance, which a lot of organisations are taking. They're more about principles about how you manage assets. And a lot of it is about, instead of saying no to things, you actually sit there and are constructive in the way that you deal with companies to try and get them to improve their behaviours, as opposed to just avoiding them. But there are some specific exclusions, and even entities like the New Zealand Super Fund, for example, does have specific exclusions, such as nuclear explosive devices and those types of things, which I'm sure the council here won't want to invest into either. Asset allocation, that comes through as a result of the risk appetite and a selection of identification of which asset classes are accepted and looking at the liquidity pieces. So at a high level, council is the one who owns the SIPO. It's council's document, it's council's principles. But you do expect your committee or your CCTO or whoever's actually managing it for you to bring recommendations up in terms of anything that may need to change. But you would expect also that committee or CCTO is the one that is involved in choosing the investment manager. They are the one that monitors the performance. They are the ones that make sure that all of the things are done right. The other thing that sits inside your SIPO is the roles and responsibilities, so that everybody knows who has what responsibility that sits there. So that's kind of the piece that we'll work on in the background, and I guess a lot of it flows through from understanding the controls, the protections, the access to capital, because that opens up your ability to determine what risks you are willing to take.
Can't we just give it to someone to manage with some strict rules?
And that's effectively it. So
even though, I mean, look, all this committee and
you do need to have the rules, because again.
I get that. It's just that, it just seems quite bureaucratic.
I think as elected members, it's important to remember that the fund still sits in our asset ownership. And along with that comes responsibilities for good management and good governance. And we do need a very clear process to ensure that the instructions to the fund manager can be articulated on behalf of the council. And so this is the mechanism to do that. We do need those mechanisms around all our assets, and we do have committee structures around all of our other assets that we manage as well and govern. And so this is akin to that.
Okay.
I'll probably just add to that I have seen instances where the fund manager has gone way outside the scope of the SIPO and effectively, if there's no governance,
Okay.
you can't pick it up.
Okay, that's helpful. The moral element. So some are easy, like don't invest in a tobacco company, hopefully. But sometimes, obviously, there might be a company that might look kind of okay, but is investing somewhere else. And so how do we track who's doing what? And can we be activist about it to say, well, look, don't do that. We don't like it. Invest in some, green technology, not bombs.
Yeah, look, so again, this is council's determination because they set what they determine as their social responsibility rules that sit within there. And that's where the key piece, as I mentioned earlier, is about those principles, because the principles are about active management. They are about making sure that your committee and, more importantly, your investment manager is actually looking at those principles to make sure that you are active and trying to look for decision making. There is also exceptions though, because you cannot be absolute about everything. It's really, really difficult. You sit there and say tobacco, but does that mean you don't like Woolworths because they sell tobacco across the counter? So you might have some limits in there in terms of maybe the percentage of revenue that they derive from the manufacture of tobacco or something like that, because you've got to, if you get too granular and you're an absolute zero, it gets almost impossible to police. But you do have, there are examples and there are funds out there that have standards that they set.
Okay. And just my last question, sorry, it was following on from John's comment. Have there been any councils so far that have gone rogue and done some silly things with funds like this?
I wouldn't say that there are councils that I'm aware of that have gone rogue. Well, no, yes, there are. I will give examples. Again, you put rules in there around what you're willing to invest into. The GFC was a great example of lots of councils internationally that were invested into very, very strange secondary bond markets in unusual countries, and they paid heavily for those. So, again, you talk about, investment grade bonds that you want to be in and all those other types of things. And again, this is part of that risk management, and this is why you want to have a team in the middle to make sure that you're not running into those things that you're wanting to do.
Councillor McNulty.
Yes, it's interesting because responsible investing was my entire thing at Kiwi Wealth. So, I get the distinction between, we would invest in some petrochem companies because we were asking them to add carbon emissions into their annual reporting through shareholder advocacy. Whereas if we took away our share, and let's say the Saudis bought in or something like that don't care about having that disclosure, you actually have that discrepancy of do you invest in an oil company to get them to behave better? So that's the conundrum. But I suppose it's interesting for us putting a SIPO over what would also, a fund manager who would also usually develop a SIPO. I guess, I take that we want to provide some direction, but fund managers would actually have a lot of strategic expertise to offer in this area. I'm worried about us making too much of this decision, because someone like a Kiwi Wealth, albeit now the Fisher Fund, would come back with this is how we do responsible investment, these are our expertise and our views, where, someone like a Simplicity who's more of an exclusionary investor of we just don't touch these industries, full stop. And I wonder, do we not want to get some of that market feedback and findings before we get too heavily creating the rules on this kind of structure?
So if I can reflect on that, I've done a number of these with a number of council entities recently, and what we're looking to do, the SIPO that we're talking about here, this normally has underneath it an investment management agreement or something that will sit there with a third-party manager that will go into the details of some of those things. So at a high level, what I'd be expecting council to do is sit there and say, this is the asset allocation that we like. These are the asset classes you can choose from. We're not telling you what the weight in each asset class is. And these are some of our non-negotiables in terms of our ESG piece. That's it. If they want to go further, that's great, but these are the non-negotiable pieces. So I don't think you're trying to go too far down the path of telling them how to work. My recommendation with regards to the non-negotiables is you try and keep it as high as you can, because, as you say, the more you put into the exclusions, the narrower you get the selection of investment managers that you can actually utilise. And at the size of fund that we're talking about here on day one, we're not a big fund. We are actually a small fund in the global scheme of things, and people are not going to sit there and go, we'll bend over and make everything easy for you guys. We're actually quite small, so we've got to be quite cognizant of what the industry actually offers.
Councillor Chung.
I'm very concerned about the, as Councillor Pennant said, about the bureaucracy of this. See, whether it's a fund manager choosing the funds, choosing the shares to actually look into, or us, I think it'll be even more problematic if we actually had a close control over it, because there are so many different things that we'd all have different opinions on. So say, for example, if we decided to invest in Boeing because they came out with a new electric aeroplane and it could fly around the world, on one battery charge, and so we think, oh, that's great for the environment and all that sort of thing. But Boeing also make fighter jets and planes, and so how would we actually decide which company we actually like? And I think there's just too many differentials. It's and again, should we even be involved in that? Should we even be looking at that? Should we actually look at what's the best investment for the council and what's the best return, rather than restricting them at all?
So again, if we take the slide that's on the screen at the moment down the right-hand side, we have roles and responsibilities. We have the role of council. You approve the high-level document that says these are the rules, right? Your committee or your CCTO is then going out there and choosing to match those rules. Who is the best investment manager who can get us the best returns, and within the rules that we've set and within the risk parameters that we've set to do that, they then monitor the performance of it. The actual selection of whether it's Boeing or anything else is done at an investment manager level. That's the third-party team that they're actually paying for expertise. But you've got those degrees of separation for council, and I think a lot of what I'm hearing here is that at the council level, you're sitting there going, we're happy to set the rules at the top, but we don't necessarily need to be involved further down. And that's actually the way that it's designed, is that you're not, you don't have to worry about whether you've bought Boeing or anything like that, because that's not the concern of this table. It's the concern of the investment manager, and it's the concern of the committee or the CCTO in terms of how is that performance measuring up, in terms of how are they delivering on what we're paying them to do.
Yeah, got to remember they are the experts and this is what they deal with. Last question before we move on, because we've got 20 minutes left. Councillor Rogers.
Yeah, it was just a question about funds of this size. Are they typically going for boutique management, or are they just kind of picking an index fund and going with it? Like, how much of this is kind of because of the requirements you might have heard from what we had set, and how much of this is kind of you believe that kind of doing this more our way is better than a sort of indexed way?
Yeah, look, it's a blend is the answer. Quite often what you'll find is at an asset class level, so at New Zealand equities level, you might find that you find a manager who goes out and picks a whole lot of stocks for you. But at global equities level, they'll probably just be into an exchange traded fund or something with an ESG overlay so that you can tick the boxes that you're looking for there. So it'll blend. And again, each of the investment managers, when they come back with their proposal to the committee, is to, because you'll have a beauty parade through an RFP or similar, they will all present how they think they can do it, and then the committee will determine which one of those scenarios they like the most.
Thank you.
The last discussion point is around this very difficult trade-off around either retaining or paying out income from the fund. As we know, the fund will make a return year on year, and there is a decision to make through the establishment of a distribution rule. Is that return retained in the fund and therefore allowed, provided for future growth? Is it paid to council to offset rates, or is it somewhere in between? And we've set out 3 scenarios on this side that establish or present those 2 bounds. The bottom one essentially says we will match the income from the ground leases that we're selling, which is about $4.5 million a year. And so if you were to establish a distribution rule that says in perpetuity pay out that income that you were going to get from the ground leases, and we overlay a 7% assumption return, you can see what the forecast growth at over 25 years looks like by line 1. It's good growth, but it's not the full capability of the fund, and therefore would provide less ability to capital for capital to grow. The other bound, I guess, is if you made no distributions from the fund at all, allowed it all to grow, and if you compounded that over 25 years at 7%, you can see there's an almost 5.5-fold increase in the capital size of the fund. So they present the two options. The trade-off in number 3, if you are paying no income from the fund out to council, is obviously an increase in rates to offset that lost income. My understanding is $4.5 million per year represents about a 1 to 1.2% increase in rates one-off, thereabouts. So that's the sort of quantum you're looking at. We've come up with a scenario that's a compromise between those two scenarios, and it's shown there under line 2, and it essentially says we match the ground lease income for 2 years. So there is no net short-term impact on ratepayers, which is consistent with what I understand was in the consultation document. And from that point on, it gradually reduces until you get to a distribution of 2% of the size of the fund. In the modelling that we've done, that's over a 4-year period. You get to a 2% long-term return. The net impact through that 4-year period is about 0.5 to 0.6% in rates, albeit it's drip fed over 4 years. So about 0.1% to 0.15% per year for 4 years. There's infinite possibilities between those lines, obviously, and open to discussion, but our inclination is something along the lines of what I've just described in 2. It's a compromise, no net impact on ratepayers, but does provide long-term the ability for the fund to grow, which is illustrated in line 2.
So if I can just add a fraction to that, we talked earlier about the distribution from the fund in the case of a disaster, which is what we refer to as a special distribution event. You've got this, which is the ordinary, the annual kind of distribution event. Both of those things, in terms of the rule that you want to try and lock into that policy, because that policy then sets itself in stone. Obviously, if you have something like a 2%, where it's 2% of the value of the fund that distributes each year, as the fund grows, the distribution grows. I mean, that's the, if you think of growing at 7%, you're paying 2% out, you're growing at 5%. That means that next year's dividend's 5% higher than it was last year. I mean, that's just the way that it will work. So there are trade-offs, as Jessie has alluded to, but again, the rule that you set for that ordinary distribution and the rule you set for the special distribution are things you want to try and lock into that policy and then try and make hard to change.
I just wanted to add one more thing there too, and that's around the impact in the year that we decide not to receive those returns to council to offset rates. So essentially, if we were to do it all in 1 year, so we reduced our revenue by $4.5 million because we were no longer getting the ground lease revenue and we were not taking any ordinary distribution from the fund, there would be a one-off rates hit in that particular year. Going forward, that base rates has already reduced and there's not an ongoing impact. So I guess, in considering which option we go for, the impact on rates is going to be just those one-off changes, if that makes sense.
All right, we'll go to our last 3 questions because we've got to wrap up by 4. So I'll start with Councillor McNulty.
Could I ask for a line, maybe it's sort of between 1 and 2, where you're going to 0%, but you're doing it over the remaining years of the LTP? So there'd be about 8 years of the LTP from execution, and you actually get it to 0%, and what that might look like? Because I think my gut feeling is there's probably it's a bit of a politician's approach, but there's probably a sympathy to actually have the fund completely reinvest in itself. You can see the literal dividends that does, but doing that, ramping that a bit over a longer period of time to get there.
Sure, we can do it. I mean, it's all hypothetical. This shows very smooth lines with equal growth in every year. The reality is not going to be that, obviously, but yeah, we can provide those numbers. Yeah, that's right.
True. Councillor Rogers.
Yeah, my question was about the more bumpiness of the lines, and it was around scenarios where perhaps the fund on a particular year didn't return a forecast amount that allows that to pay out a dividend. I guess in that scenario, is there an expectation that capital would be drawn out, like investment would be drawn out to pay that dividend anyway? Sort of how do we negotiate those?
Yeah, look, again, it's got an ordinary distribution which is set as an amount which you try and pay on an annual basis. Yes, 7% is a kind of nice middle line assumption. If you look at the Dow Jones for the last 110 years, it probably has had very few years between 6 and 10 it's always higher or it's always lower, so it is, but it averages out. So our expectation is that you set yourself a rate of distribution, you're able to take that, and as long as you're a long-term investor, you're not changing where you're sitting, you'll get the upside when it comes.
Cool. Thank you.
Oh,
No, he still wants it. I just was.
Councillor Brown, your last question.
Oh, lucky old me. It's sort of more of an observation rather than a question, but just in terms of the distribution, I was actually meeting with Nikau Foundation yesterday, and they establish perpetual funds for people who want to actually provide perpetual giving, and their rate of distribution is 3.5%. So, but they've got obviously a super long-term aspiration with the fund, and I haven't looked at exactly how aggressively they invest, but it is interesting that they are looking at 3.5 in current circumstance, because obviously it's not just keeping your capital intact, it is also CPI that is important. And I think the New Plymouth Investment Fund also does the same. I think they might be at slightly over 3.5, but it's exactly the same principle of setting a 5-year rate of distribution so that the council would know exactly what it was going to get for the next 5 years, and would be the actual investment returns would be sort of separated from what council was going to get as a rate deferral, which I think that sort of idea of setting a rate of distribution for a medium-term period of time is a really smart way of doing it, and then you could separately decide on your investment profile.
Yep.
So you were dead right. And you've probably illustrated the point perfectly, because every council is different. And I know my old organisation, we were about 3.5 as well. So that's fine. I guess the purpose, and it comes back to what is the purpose of the fund that we're trying to create here. And in one sense, we're looking to try and retain as much as we can, to grow as much as we can, to narrow the gap that you're trying to affect. So I think for a lot of those other funds, it's about feeding the existing ratepayers or feeding distributions out to a greater reason today. This one here has a bit more of a longer term purpose in terms of it's actually the capital protection, which is why potentially we've looked at 2%.
And at the other extreme, the Auckland Future Fund essentially pays out everything other than CPI. So it takes its return, its forecast return, deducts CPI, and then pays everything out as income, because it's trying to use that as a form of income rather than growing as much. Yeah, I'd have to think about it.
I think their target payouts are based on they've got a 7.25% roughly assumption, 2% CPI and 5.25% payout, and that's their standard model that they're going for. So they're on a much more aggressive payout model, but again, they're feeding the current ratepayers as opposed to growing the fund for a purpose. You're trying to grow the fund for a purpose, and so therefore your payout ratio potentially would be smaller. Again, look, all of these things are modelled on long-term expectations. So, they've got an expectation here. We've probably got an expectation which is not too dissimilar. It's just really the level of payout, which is because the purpose of the fund is to grow and fill a gap, whereas Auckland doesn't have that same purpose.
Okay, I'll just point out that in the case studies in the appendix, it does talk about the individual councils through there, and Auckland is actually included. So I'll just hand over to Raina now to wrap up.
Right, so obviously there was quite a lot of information to absorb. Some of those decisions may be quite controversial, and there's going to be a lot of differing ideas on what that looks like. So just looking ahead, we will be bringing a committee report around some of these key decisions for you on the 20th of August. However, during August, we will also have a drop-in session so that you can get that report, see what we're looking at, and then help or ask questions and give us feedback. As we look to the new council being set up, in December we will bring back the decisions around the potential committee structure and what that looks like. So that's the decisions around how many people will be on that committee, independents versus elected members, etc. And then as we look to February, March, that's when we're looking at getting the fund established and appointing the investment manager. So what are we now? June. So that gives us 8 months. 8 months to kind of go through those processes, draft up all the documents, have the key decisions made here for us to continue working through that. That's the end of the session. Happy to take more questions. Also happy to get more feedback from you via email, and we can look to provide responses and queries on your feedback and things.
I think
as well.
any further questions, if they can be filtered through Raina, I should be happy to coordinate those. And if as elected members you have strong views on which option you think you want to pursue, please also have conversations with your colleagues, have that discussion, bring that to us. We'll look at it.
Because ultimately in August we do have to bring to you, I guess, what our preferred option is in order to provide that information on that option. However, we'll also be considering the other options and the advantages and disadvantages of those as well.
Okay, we'll wrap it up there because we do have another session coming up. But thank you, Jessie. Thank you, Scott, for coming in and presenting, and very useful.
And thank you.
So, and thank you, Raina.
Thanks,
Thank you, Andrea.